Alright guys, welcome back to another video, and I think you guys can already tell that my chart is looking very different today. It is very different from the macro market structure model that I've always been talking about. As you can see that we are on Tesla, we have a couple of indicators, and this is nothing like what I've talked about in the past. And I did want to make this video because I do want to start taking the channel in the direction of, yes, macro and market structure, but I want to talk about something that's very near and dear to my heart that I trade every single week and is probably more consistent than day trading, but a lot of people don't know about it because they're all so hung up on this get rich quick style of trading. What I'm talking about is selling options specifically. So the wheel strategy is something I've been doing for a while now. It makes up a good amount of my trading profits every single month. It is aside from my actual live account, and this actually grants me more consistent returns than my active trading. And I will say, as a trader, you do want to have different kinds of income sources, whether that be a different style of trading, a whole different business, or something else altogether, just because it gives you that peace of mind when it comes to taking your active day trades, and you kind of know that you have this guaranteed income coming in. So for me, this isn't about actively holding stocks. I very rarely hold stocks long term. I'm more interested in selling cash secured puts, covered calls, and I wanted to make this video explaining what these are, how I actually do this, and how this is probably one of the most powerful models you can be trading with, because this is such a high income skill that you guys already have if you're good at trading, that you're just applying it to something else and changing the facts a little bit. Yes, I know some of you are Forex traders, futures traders, and none of you are really options traders from what I've read so far, but I promise you, by the end of this video, I think I will have convinced some of you that this is a very, very good model to study and something that you can be getting into in the future. And one of the biggest reasons I like this approach is because it's simple, it's more consistent, it's way less time consuming than day trading. I'm not staring at charts all day, I'm not guessing short-term direction, I'm not reacting to every single candle, I don't need to. Instead, I'm structuring my trades where I already know the price I want to own a stock at, the outcome I'm okay with, and what happens next. So in this video, I'm going to walk you through what a cash secured put actually is, how assignment works, the difference between in the money versus out of the money, how covered calls fit into this, and it all ties together in a way what people call the wheel strategy. I know this is probably a lot of terms that you guys haven't heard before, so I do beg you to stay with me on this because it is very, very rewarding once you actually understand it. So to do the wheel strategy, it is comprised of 3 parts. Selling a cash secured put, getting assigned or it expiring, and finally selling a covered call. So in doing this, what is a cash secured put? That is step 1. A cash secured put is basically just a paid limit order. The easiest way to understand this is an order that is basically a limit order that pays you while you set it. Now, I know that doesn't sound like I'm saying that correctly, but I promise you that is exactly what I mean. It's a limit order that pays you to set it. Normally, if you want to buy a stock lower, you would just place a limit order and wait. But in this case, you actually get paid for waiting. With a cash secured put, you're basically making an agreement with the market to buy a stock at a lower price, and you're setting aside cash in your account to do so. And the market will pay you upfront for that agreement. The one important rule with this is that options always control 100 shares. So when you sell a cash secured put, you're agreeing to buy 100 shares of the company at your chosen price. And this is why you need full cash amounts set aside. I don't like using leverage or margin at all for this. You guys should not be doing this. You can do this with even $3,000 in an account to start, and you can be hitting your 4% consistent months. I'm using Tesla in this example because I do have a real life Tesla example that I'm currently in right now, and I want to go over it. So basically, as you can see with this blue line right here, I made a promise to buy Tesla at $440 if it dipped below. This was when Tesla was trading at around $474 a share. So I said, hey, if Tesla drops to $440, I will promise to buy 100 shares at that price. And I got paid a premium for doing so. I believe the premium was around $450 for making this promise. I will get into the timing and aspects of this, but this was $440 I made in a week just making this promise to the markets. So in this case, I did get assigned right here on this blue line. As you can see, that goes right across. As you can see, this did not turn out very well. Tesla dipped a lot lower before recovering. So was I absolutely shitting bricks in this period of time? No, because I want to own Tesla at a lower price. I wouldn't buy it up here, but I would be happier buying it in the middle of all this resistance levels right here. So that's exactly what I did. I made that promise to the markets. I got paid to do so. And as you can see, we are way out right now and higher than what my share price actually is at. So here's where people get confused. I'm going to start talking about terms like in the money or out of the money. So what does that actually mean? With a cash secured put, when I say out of the money, that means the stock is above your price. I don't own it yet. So if I had this line right across here, like I do here for my strike price, if the price of the asset was above it, this means we are out of the money. We are still above my price. I do not own it. If we are below this line, this is what in the money means. The stock is at or below your strike price, and this is where your assignment becomes possible. All an assignment is saying the market saying, hey, you made this promise, we are assigning you this promise at the price you wanted, which means you will own those shares of stock at the price that you selected. The short form of thinking about this is out of the money, you're just waiting. In the money, you're closer to owning the stock. So what does assignment actually mean? You bought the stock at the price you agreed to. So if my Tesla strike price was right here at 440, I bought the stock at the price that I agreed to, and that is it. If assignment scares you, the strategy is wrong from the start because you should only be doing this on stocks that you're already comfortable owning. For me, assignment isn't failure, it's just the next step in this strategy. There are some conditions that I trade like this where I don't mind getting assigned on a stock, but to me, it does depend on the length of how long I choose to have this cash secured put for. If this is a week thing, maybe I don't really want to own the stock after a week. If this is a monthly cash secured put, this gives me more room to actually have the stock at a lower price, which I wouldn't mind owning it at. Instead of having it at 440, maybe I would have picked it up at 400 or 405 down here. So for this example, I owned Tesla right here at 440. So all I'm doing at this point is not panicking, first of all, because as you can see, Tesla took a huge dive from here. So when I wake up the next morning and I see, hey, you know what, I got assigned on these shares, what is my next move? The next move for me is doing something called a covered call. And this is basically just saying you're getting paid once you own the shares. Now you say, once I own the shares, now I have a new tool, a covered call. A covered call means I already own 100 shares of a stock and I can sell someone else the right to buy them from me at a higher price. So now I've already been paid to buy the stock with the cash secured put coming down. And now I can get paid again while I own it when it comes back up. So in this case, if Tesla is sitting down here and I chose to sell a covered call right at 440, which would have been the break-even price, and it didn't come above it in the week that I set that for. If the stock never reaches that higher price, I just keep the money. If it does reach this price, I sell for a profit. And again, this is all time-based. Like I said, if we hop onto Interactive Brokers, you can actually see how this works in real time. You can set how far in advance you want to do this for. So in this case, with it being Tuesday, I like to do weekly cash secured puts or covered calls, which means they expire at the end of each week on Fridays. So you can actually do this right now on Tesla. So with Tesla trading at $480 a share right now, and I said I would be comfortable owning Tesla at $470 a share. That means I'm making a promise to buy 100 shares at $470 a share, meaning I would have to tie up $47,000 to make $600. As you can see, it says $6 right here, meaning $6 per share, which also equates to 6 times 100 shares, meaning $600. So to make this promise, I would have to hold Tesla for 3 days, tying up $47,000. That doesn't mean the $47,000 is assigned on those Tesla shares. What it means is I'm saying I will set aside $47,000 in the case that if Tesla drops to $470 a share, I will buy it for that price. And in the meantime, in those 3 days, I will get paid $600 upfront to do so. I use Interactive Brokers for this. This is just the easiest instrument for me to, be able to actually see this. I think they have the best interface and it's very easy to use in a case like this. But to each their own. If you guys have a different platform that you want me to break down, I can definitely do that. But I can go through, make a separate video exactly how to place an order on this kind of thing. But for the time being, we'll just look at it through here. Like I was saying, if I sold that 470 Tesla strike price and I got paid $600 up front, Tesla ends up coming down to 470, which on the chart is right here. So if Tesla came down and assigned me right here, I'm not panicking because what I can do is sell a covered call. So I already own 100 shares of Tesla at this price. So if I chose to sell a covered call, say back at these highs, 482, we can go back to Interactive Brokers, find 482, and the closest would be 482.5. So if we chose to sell a covered call, that means we would make $7.70 per share times 100, $770. In a case like this, we have 3 days for Tesla to come above this price. And if it does, that means that the shares get pulled away from us, but we get paid $770 just for making that promise to sell it up here. Now in doing so, we also have the stock gain from here to here. So in this case, if you own Tesla at 470 and it came all the way up to 482.5, that's a 2.6% stock gain on top of the $770 that you just made in premiums. And again, if the stock never reaches that higher price, I just keep the premiums and then run it back again next week. If it does hit that price, I sell the shares for a profit and for the premium that we already received. I usually like covered calls when the stock is moving kind of sideways or kind of slowly up, not so much when it's jumping like this. I'm okay with selling at the price and the volume is decent, but I avoid covered calls when I expect a strong breakout of the stock and I want to hold the stock long term without any interruption. Say I wanted those 100 shares over a longer period of time, then I would actually hold it without selling a covered call. So how does this all work together? And this is what people call the wheel strategy. You sell a cash secured put to get paid while waiting, you get assigned and you own the shares, and then you sell a covered call to get paid while holding it. If the shares are sold, you just repeat the process. But here's the key. You don't force the wheel. You let the market decide when each step happens. So in a case like this, if Tesla is trading at $458, you made a promise to buy it at $440, which is down here, and Tesla comes below, assigns you shares at $440, you can sell a covered call and get rid of it, say at $458 again, you get this stock gain, and you make the premium for selling it back above this area. This approach obviously works for me because I'm not dependent on perfect timing, I'm not glued to screens, I'm working with probabilities and not emotions, and I'm okay with small consistent wins that add up over time. You know, there's fewer decisions, it's a slower pace, that's what makes it sustainable. I should say that there are inherent risks to this because if you do choose a stock, you know, it could be anything, it could be a NASDAQ or S&P 500 type stock that could tank like Uber is right now. And say if you don't have your cash secured puts or covered calls in the right places, you could actually be stuck bag holding for a while. There is a stock right now that I'm actually down on called IREN. Let me just pull that up right now. As you can see, I sold a cash secured put right here and we are trailing off hard. I am down big on the share price itself, but this is a stock that I want to own long term. So I don't mind just continuing to sell covered calls and waiting for it to get back up here, because once I do that, I've been collecting premiums this entire way up and selling it for a profit when it finally gets back to that point. Obviously, this is not financial advice. This is just a recommendation. I do make personally around 4 to 6% per month doing this strategy. I am very tactical with how I place my cash secured puts, you know, whether I want, and I can usually tell if I want them to expire worthless or if I want to be assigned on a stock in a particular price. At the end of the day, if this isn't about replacing trading, it's about the structure. Cash secured puts help me control my entries, covered calls help me manage exits, and the wheel just ties this all together. And this is completely aside from my active day trading that you guys see. It's simple, boring, and consistent, because when you have a big account that you built up from day trading, you can do something like this that is super, super low stress, boring, but very consistent. If you guys want another video, I can add some more examples to each section, you know, create maybe chapter timestamps to help you guys actually understand, you know, certain aspects and make a full series based on this. I think I will start making weekly videos, basically showcasing what I'm looking at for the week and even showing some of my positions. There's no gatekeeping for me. I really don't mind doing that. But I hope you guys enjoyed this. If you guys have any questions, please leave it in the comments. I know this is a very new topic that I haven't talked about, so I understand that there will be questions. But with that, we'll see you guys in the next one.